next time you hear the Federal Reserve raising or lowering interest rates, remember, it's not just a headline for Wall Street. This directly impacts how much banks can lend, how much they earn, and ultimately how much you pay on your mortgage, your car loan, or even your credit card. The Fed is the invisible partner in every transaction you make, and the banks have learned how to play this relationship to perfection. Have you ever wondered why banks seem to always win, whether the market's booming or crashing? Today, I'm going to peel back the curtain on how banks actually operate, how they own mortgages, how they pay the Federal Reserve, and how the system gives them the power to lend money over and over again. And then we'll dig into the different investments banks really make behind the scenes. Spoiler alert, it's not just mortgages. Let's start at the foundation, mortgages. Most people picture it like this. You walk into a bank, sign a mountain of paperwork, and the banker hands you money out of some giant vault in the back. That's the Hollywood version, but the real story is far more interesting. When you sign that mortgage note, you're actually creating an asset for the bank. Think about that. Your promise to pay 15, 20, or 30 years becomes one of the bank's most valuable possessions. On their balance sheet, your mortgage is listed as an asset because it generates income every single month in the form of interest. For you, it's a liability. You owe the money. For them, it's an asset. They own your debt. Now, I learned this the hard way. When I bought my 17 unit, I thought I owned that property. But the reality, the bank owned the mortgage. And that mortgage, my monthly payments, was their guaranteed income stream. Even when a driver ran into one of my units and completely destroyed it and I had to submit thousands and thousands of dollars, the bank still expected that check. My loss didn't change the fact that on their books, my loan was an income producing asset. Now here's where it gets even more interesting. Not all mortgages stay with the bank that originated them. Some are called portfolio loans. In this case, the bank literally keeps your mortgage in-house. They hold the note, they service it, and they collect every interest payment you make for the life of the loan. That situation with my 17 unit, the bank held on to it because it was small enough to keep on their books. But most mortgages today don't stay with your local bank. Instead, they get sold into what's called the secondary market. That means the banks bundle your mortgages with thousands of others, then sell these loans to big players like Fannie Mae, Freddie Mac, or even investment funds. When they do that, the bank gets its money fast. And with that money back, guess what they can do? They can make another loan, and another, and another. So why would a bank sell a good, steady income stream like a mortgage? The answer is leverage and liquidity. By selling the mortgage, they freed up their capital. They don't have to wait 30 years to collect every payment. They get a lump sum today, and that lump sum can be used to fund 10 more mortgages tomorrow. It's all about velocity, turning money over and over again to maximize their profit. But here's something most people don't realize. Even when your mortgage gets sold, your local bank may still handle the payments. That's called servicing the loan. So you keep mailing your checks or today clicking that Pay Now button to the same bank. But behind the curtain, they may no longer own your mortgage. They're just collecting payments on behalf of the investor who does. And yes, they still get paid a fee for doing that. So the next time you think about your mortgage, remember this. It's not just about you borrowing money to buy a house or to buy a complex. It's about the bank creating an asset, deciding whether to keep it for steady income or selling it for speed and scale. Now, when I lost money on that complex, the lesson hit me square in the face. I was playing checkers while the bank was out here playing chess. And either way, they win. And this is just the first piece of the puzzle in how banks generate wealth. So now that you understand how mortgages themselves work for assets, for banks, let's zoom out and look at the bigger machine that powers it all, the Federal Reserve. Because without the Fed, banks couldn't play the lending game at the scale they do today. Every bank in America has what's basically a master checking account at the Federal Reserve. That's where the reserves are held. Think of it this way. Just like you have a checking account at your local banks, banks themselves keep their checking account at the Fed. When you make a deposit into your bank, say $1,000, that money gets recorded as a liability on the bank's balance sheet. But behind the curtain, that same transaction impacts the bank's reserves at the Fed. Your deposit allows the banks to increase the balance they can use to lend. Here's where the system gets really powerful. The Fed doesn't require banks to keep all your money in their account. Instead, under what's called fractional reserve banking, they only need to keep a fraction. So if you deposit 1,000, the bank may be only required to hold 100 as reserves. The other 900, they can lend out. And when they lend out that 900, guess what happens? The person who receives it deposits it into their bank, creates another deposit, which that bank can lend on again. So your original $1,000 can ripple through the system, turning it into $9,000 or $10,000 of new loans. That's how banks literally create money, by multiplying deposits through lending. But there's another layer most people don't see. Banks don't just store reserves at the Fed. They can also borrow reserves from the Fed, paying interest on these loans when they need extra liquidity. This is where the discount window comes in. Emergency lending straight from the central bank. And here's the kicker. The Fed also pays banks interest on excessive reserves, basically rewarding banks for keeping extra money parked there. So not only can banks borrow from the Fed when they need cash, they can also earn interest when they've got too much cash. It's a win-win structure for them. Now, why does all this matter? Because the Federal Reserve System is what allows banks to operate on leverage. It's what allows them to lend out far more money than what they actually hold, and it's why banks are so powerful in shaping the economy. Think about it. Your single deposit doesn't just sit there. It becomes the foundation for loans to small businesses, to home buyers, to corporations, and to governments. The Fed's role is like central gear in the machine. It sets the rules, sets the cost of borrowing money, and it literally determines how much credit flows through the economy. So next time you hear the Federal Reserve raising or lowering interest rates, remember, it's not just a headline for Wall Street. This directly impacts how much banks can lend, how much they earn, and ultimately how much you pay on your mortgage, your car loan, or even your credit card. The Fed is the invisible partner in every transaction you make. And the banks have learned how to play this relationship to perfection. Borrowing when it's cheap, earning when they save, and multiplying money at every turn. Now that's the Federal Reserve connection. And in the next section, we're going to look at why this matters to you and how banks use these tools to invest far more than just mortgages. So now that we know how banks create assets out of mortgages, and we've seen how the Federal Reserve System allows them to multiply deposits through lending, here's a real question. Why does this matter to you and me? Because this system shapes everything: our homes, our jobs, our businesses, even the value of our savings. When you deposit the money in an account, it feels like your money is just sitting there, safe and untouched. But the truth is, your deposit is fuel to the banks to use to create loans. That $1,000 in savings, it could become part of a small business loan across town that lets a local family open a restaurant. Or maybe it's bundled into funds for a student loan that helps a kid pay for college. Or it supports a car loan, a construction loan, or a massive commercial real estate deal. Your deposit isn't just sitting there. It goes out into the economy, multiplied, and comes back in the form of new growth. Now here's the key. Banks make money on the spread. That's the difference between what they pay you in interest on your deposit and what they charge the borrower. If they're paying you 0.5% interest on your savings account, but charging 6% on a mortgage, that's a 5.5% spread. Multiply that across billions, sometimes trillions of dollars, and you see why banks are so profitable. It's like running a business where the raw materials are free or cheap, and the finished product sells at a massive markup. That's banking. But it's not just about how banks make profits. It impacts you directly. When the Fed raises rates, banks pass that cost along. Your credit cards get more expensive. Your mortgage payments rise. Your car loan costs more. And when the Fed lowers the rates, money flows easier. You might be able to refinance your house, borrow to expand on your business, or get approved for a line of credit. So whether you realize it or not, the system of deposits, reserves, and lending is shaping every financial decision you make. Now, I saw this firsthand in real estate. When I was running the numbers on one of my multifamily deals, the difference of just 1 percentage point in an interest rate made or broke the deal. The bank's cost of borrowing from the Fed determined the rate they charged me, and that one shift completely changed the cash flow picture. That's how tightly connected we are to this system. Here's the bottom line. No matter what, banks find a way to win. When times are good, they lend more, invest more, and collect more interest. When times are bad, they get bailed out or they shift into safer assets like government bonds. Meanwhile, the rest of us, homeowners, small business owners, investors, we're the ones riding the roller coasters of rates, access to credit, and loan terms. So why does this matter? Because if you understand the rules of the game, you can start playing a little bit differently. Instead of just being the person making deposits and paying interest, you can learn to position yourself more like the bank, using leverage, creating cash flow, and multiplying your money. And that's exactly where we're headed next, looking at the different investments banks actually make and how you can model your own investing strategy after theirs. Now, up until now, we've talked about mortgages, deposits, and the Federal Reserve. But let's shift gears because banks are not just about checking accounts and mortgages. They're massive investment machines. And the way they invest should open your eyes to what you can do in your own financial life. So let's break it down to the main types of investments banks actually make and what they put their money into, how it works, and why it matters. 1. Mortgages and mortgage-backed securities. We have already touched on this, but let's go a little deeper. Banks own mortgages directly. Those long-term steady payments are like bonds, predictable streams of income. But they also buy mortgage-backed securities. That's when thousands of mortgages are bundled together and sold as a single investment. For the bank, it spreads out the risk. Even if one homeowner defaults, the pool keeps paying. It's steady, reliable, and massive. Trillions of dollars sit in these securities worldwide, and the lesson here, banks love assets that turn small monthly payments into long-term streams of wealth. Number 2, U.S. Treasury bonds and government debt. Treasuries. These are the safest investments on the planet, backed by the full faith and credit of the U.S. government. Banks love them for 3 reasons. They're liquid, they're safe, and they count towards regulatory requirements, meaning holding Treasury keeps banks in compliance. So banks always keep a big slice of their portfolio in Treasuries. For you, this is like having your safe bucket, your emergency fund that you know will be there when you need it. 3, corporate loans and bonds. Banks also invest heavily in corporate world. They issue loans to companies looking to expand, acquire, or cover operating costs. But beyond loans, they buy corporate bonds, basically IOUs from big businesses. These bonds often pay higher interest rates than treasuries, but with more risk. The bigger the risk, the bigger the return. And the banks balance this constantly, mixing safe government debt with higher yield corporate debt. Think of it like your own portfolio. Stocks versus bonds, safe versus aggressive. Number 4, consumer loan. Now here's a big one most people forget, consumer loans. Credit cards, auto loans, student loans. Credit cards especially because these are gold mines for banks. Why? Because they charge double-digit interest rates, 15, 20, or even 25%. And on top of that, they collect late fees, annual fees, transaction fees. So while your savings account may be earning a 0.5 percentage point, your credit card balance is being billed at 20 times that. That spread is pure profit. 5, real estate investments. Banks don't just invest in home mortgages. They're also knee-deep in commercial real estate. Office buildings, shopping centers, industrial parks, multifamily apartments. Sometimes they're the lender. Other times, they may take direct equity positions, meaning they literally own part of the property. And here's where it ties back to us. When you buy a duplex, a 10-unit, or even a 50-unit, you're playing the same game banks are playing. The only difference is scale. Number 6, derivatives and hedging. Now let's talk about the big leagues. Derivatives, interest rate swaps, currency swaps, future contracts. These sound complicated, but think of them as financial insurance policies. Banks use them to protect against changes in interest rates, currency values, or commodity prices. But here's the truth. Sometimes these derivatives become profit centers of their own. The 2008 financial crisis, largely caused by banks going too far into risky mortgage derivatives. When they win big. When they lose, well, taxpayers bail them out. 7, equity investments. Banks also invest directly in stocks, ETFs, and mutual funds. usually through their wealth management arms. Think JP Morgan, Bank of America, or Goldman Sachs. They're not just lending. They're investing right alongside hedge funds and Wall Street traders. It's another way to diversify their income. 8. Private equity and venture capital. And finally, some banks or their subsidiaries invest in startups and private companies. This is where they chase high risk, high reward opportunities. Tech startups, biotech firms, energy plays. They're not betting on safe returns here. They are betting and swinging for the fences. And even if 9 out of 10 fail, that one winner can produce outsized returns. So let's step back and take a look at the full picture. Banks don't just sit on deposits and hand out mortgages. They spread their money across mortgages, treasuries, corporate debt, consumer loans, real estate, derivatives, equities, and even startups. They diversify and they multiply. They create streams of income from every direction. And here's the real lesson. If you want to build lasting wealth, you need to think the same way. Diversify your income streams. Balance safety with risk. Create assets that pay you over time. Because banks have already proven this, and it works. Now, in the next section, we'll talk about the business model of banking itself. How all these pieces fit together into one profit machine that rarely loses. So we've walked through how banks hold mortgages, how the Federal Reserve powers lending, and how banks diversify into every type of investment you can imagine. But let's simplify it. Because at the end of the day, the business model of banking comes down to a handful of steps. Here's the formula banks live by. Take deposits at low cost. They borrow money from you, yes, that's what a deposit is, for almost nothing. Maybe they pay you 0.5% on a savings account. They lend or invest those deposits into a higher return. They take your money, they put it to work. Mortgages, credit cards, treasuries, loans, and those earn them 3, 6, 10%, and sometimes 20%. Pocket the spread. The difference between what they pay you and what they collect is their profit. It's simple, it's powerful, and it scales. It becomes enormous. And here's the secret sauce. Banks don't just make money off the dollars they already have. They multiply it through the Federal Reserve System. Your $1,000 deposit becomes $9,000 or $10,000 of loans, which means banks are earning interest on money that didn't even exist until they loaned it. It's like playing Monopoly with the ability to print more money every time you pass go. Now let's add a diversification. Banks don't just put all their eggs in one basket. They spread it across investments. So if one area takes a hit, say real estate values fall, they still have treasuries paying them. If interest rates rise and mortgage volume slows, they still have credit cards spinning off double-digit returns. It's balance, it's hedging, it's risk management at scale. Now I'll be honest. Now this hit me hard in my early investing days. I had no diversification. That one property sinking meant my whole plan sank with it. But banks, they never let one deal take them down. They're always spread out, always covered, always finding their income streams. And that's when I realized if I wanted to play this game like the banks, I couldn't just buy one property and hope for the best. I needed a system, a portfolio, and that's where the bounce method was born. And here's the final piece. Banks rarely lose. Even in recessions, they built such a deep foundation in the economy that government bails them out. Because if the bank fails, the whole systems fail. Because if the banks fall, the whole system falls. While you and I might be fighting to pay off mortgage or save for retirement, the banks are running a model that guarantees long-term wealth. They understand leverage, they understand diversification, they understand how to use other people's money to build empires. So when you strip it down, the business model of banking is shockingly simple. Take deposits cheap, lend expensive, multiply through the Fed, diversify everywhere. That's it. That's the playbook. The question for you is, how can you borrow that playbook and start running your own version, whether in real estate, business, or personal investing? Because if you don't, you'll always just be the customer helping the bank get rich. Now up next, we'll connect this directly to you. How understanding the bank's model changes the way you invest, spend, and build wealth for your future. Now we've spent some time breaking down how the banks hold mortgages, how the Federal Reserve powers their lending, and how they diversify their investment. But now let's bring this back to where it really matters to you. Because here's the truth. You may not own a bank, you may not have $1 billion in deposits, but you can use the same principles banks use to build wealth in your own life. Think about the spread. Banks borrow money cheap, your deposits, and lend it out at higher rates. That difference is their profit engine. Now look at your life. When you buy a rental property and finance it at 6% interest, but it produces 10% cash on cash return, guess what you just did? You played the spread just like the bank. That's the first shift. Start looking for ways where borrowed money, invested wisely, produces a positive gap in your favor. Number 2, multiplying your money. So multiplication. Banks don't let dollars sit idle. They recycle it through the system, lending it out again and again. You can do the same with real estate. It's called velocity of money. Refinance a property after it gains value. Pull your capital out and use the same dollar to buy the next deal. That's how you build momentum. That's how you scale. It's the same playbook that banks use, but on your own terms. Number 3, diversification. Banks don't rely on one loan, one investment, or one asset class. They spread their risk across mortgages, treasuries, credit cards, etc., 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 and you should too. Start with one property, but don't stop there. Layer in different strategies. Multifamily flips, long-term holds, maybe even partnerships. When one deal underperforms, another cushions the blow. That's how you avoid the mistake that I made early on, putting too much money into a single duplex and getting wiped out when it flooded. One property nearly sank me. Banks don't make that mistake, and neither should you. Adopt the bank mindset. Banks never think small. They think in decades. They think in portfolios. They think in systems, not in single transactions. That's the mindset that I want for you. Stop thinking like a borrower who's just trying to get approved for the next loan and start thinking like a bank, someone who uses their money as a tool, not as a trap. So here's the challenge. Take what you've learned from the banks and apply it to your own investing. Play the spread, multiply your money, diversify your income, adopt the long-term mindset. Because once you start playing like the banks, you stop being the customer fueling their profits, and you start being the architect of your own financial freedom. Now in our conclusion, I'll tie all this together into one big lesson. Why banks always win and how you can take their playbook and finally put it to work for you. So let's step back and take a look at the big picture. We started with mortgages, how your signature on a loan becomes an asset for the bank. We peeled back the curtain on Federal Reserve, how it allows banks to multiply money through fractional reserves. We saw how banks turn your deposit into loans that ripple through the economy, and we dove deep into their investments, mortgages, treasuries, corporate debt, consumer loans, real estate, derivatives, venture capital. Finally, we simplified the entire business model into one formula. Take deposits cheap, lend or invest expensive, multiply through the Fed, diversify everywhere. That's banking in a nutshell, and it works every single time. Here's the point. Banks rarely use. Even when the markets crash, they've built such deep roots in the economy that governments bail them out. Why? Because their survival isn't optional, it's essential. And why that might feel unfair, it teaches us something powerful. Banks win because they follow a simple, repeatable system. They don't bet everything on one deal. They don't put all their chips on one property or one borrower. They spread risk, they multiply money, and they always think long term. So ask yourself, are you living like the customer fueling the bank's profits? Or are you ready to start living like the bank? Playing the same game they've been winning for centuries, because you can. When you buy a multifamily property, you're creating an asset just like the bank does with a mortgage. When you refinance and roll your equity into the next deal, you're multiplying money, just like the Feds allow banks to do. When you diversify across flips, rentals, partnerships, and cash flow plays, you're hedging your risk, just like they do with treasuries, bonds, and securities. You may not have $1 billion under management, but you can follow the same blueprint. And if you stick with it, your wealth compounds just like theirs. Now, this is why I created the bounce method. It's a step-by-step playbook for investors who want to stop being the customer and start being the bank. I've lived it. The failures, the flooded duplex, the $1 million wins, and now I teach it so you don't have to learn it the hard way. So if you're ready to stop letting banks play chess while you're stuck playing checkers, if you're ready to leverage, diversify, and multiply like they do, then I want you to check out thebouncemethod.com. Because once you understand how the banks win, you can finally start using their playbook to build your own freedom. The banks have proven one thing beyond a doubt. It's not about who has the most money. It's about who knows how to play and use the money to the best. It's about who knows how to use money the best. So stop playing small, stop playing their game as a customer, and start playing it as an architect of your own financial future. The banks always win, and now it's your turn.